Hello everyone and welcome to the put called Genie. This is Juan Sarmiento with the first episode in the series, the Genie trade. Today I'm going to tell you about the basics. The Genie trade consists of one front month short straddle selected from a chain with less than 30 days to expiration. This is combined with two long back month straddles selected from a chain with more than 90 days to expiration. Let me show it to you in the trading platform. To create a short straddle, we go to the Analyze tab and look for options that have less than 30 days to expiration. Because there are too many strike prices, I'm going to enter here 2, 3, or 4 at the most, and look for the options that are slightly in the money or out of the money. Here we right click and then select Analyze Sell and look for straddle. And here it is, the straddle. The short straddle has one short call and one short put, and as you can see they both have the same strike price. That allows us to look at the risk profile of the straddle. In order to look at the probability of success, select the date of expiration from this date field and look for February the 8th in this case. And then over here, we set the slices to the break-even point with that same expiration, one day after 8th of February. That gives us the probability of success. Now, to complete the Genie trade, we go back to the Add Simulated Trades and look for a chain of options with more than 90 days to expiration, but not a whole lot more. We look for the options that have the same strike price as the options we have sold. We select the line and pressing the Control key, we right click and then say Analyze by Trade, and once again we select straddle. We repeat that, Analyze by Trade, straddle, and that creates our Genie trade. As you can see, we have two back month lock options expiring April 18th on this particular example, and one front month short straddle here expiring on the February the 8th. Look at the risk graph, and this is what it should look like. It looks like a calendar spread with the ends kicked out. Make sure you look at the implied volatility of the options that you are selling and buying. Make sure that the ends of your risk graph are kicked out higher, which means you would make profit if the stock goes up or down significantly. Take a careful look at the Greeks here. Make sure you set reset slices here so that we have here the current price, so that we can look at the delta. As you can see, the delta is slightly positive. Theta is negative, but it should shortly become positive, as every day that passes will give you a profit because it's equivalent to a calendar spread in this area. And Vega should be positive, which means an increase in implied volatility will give you additional profits. Consider this. We can experiment a little bit by clicking here and saying volatility adjustment. Imagine that the implied volatility increases even by 2%. That is not a whole lot. Just that 2% increase in implied volatility cost us a profit. Imagine if there is a big market spike in volatility at 20%. Then suddenly we have big profits. Imagine if the stock was to fall, let's say 10%. That's 25 points and it goes to 225. If that was to happen, implied volatility is likely to rise, let's say to 30%, if it happens overnight. And then your profits will become very, very large. If there is a big market decline because of the beginning of a bear market or whatever reason, and the stock drops to 180, the implied volatility should even rise more. But you can see now that our deltas are so negative that our profits will begin to accumulate. This regardless of time passing by. So our goal with the Genie trade is to make money in big moves up or down. And if there is no big move, theta will be able to accumulate profits as well. So we are in a safe situation. Let's talk a little bit about option synthetics. Every stock holds in itself the potential profit of a long call and the potential loss of a short put. This is what is called a synthetic stock, a long call and a short put. You will often hear the name synthetic combo. It is really the synthetic expression of a stock. We know that the Genie trade is composed of 2 long calls, 2 long puts, 1 short call, and 1 short put. Using synthetics, we can create a new trade called the Seagull. Let me explain. Here we have the Genie trade, as we expressed before. 1 short put, 1 short call, 2 long puts, 2 long calls is the Genie trade. Using synthetics and a little bit of algebra, if we were to add a synthetic stock to each side of the equation, we could transform the Genie trade. Observe how a long call cancels the existing short call, and the short put adds to the existing short put. So now we have 2 short puts, 2 long puts, and 2 long calls. It is still the Genie trade plus the synthetic combo. Next, we move this synthetic combo back to the other side of the equation. The long call is transformed to a short call, and the short put is transformed to a long put. Therefore, we can cancel one of the 2 remaining calls, and we can add to one of the existing long puts. The resulting trade is equivalent to a Genie, but we're going to call it the put Seagull, which consists of 3 puts, 2 short puts, and 1 long call. Let me demonstrate. Suppose that we want to create a Genie trade on Netflix. We would go to the strike price that is at the money, in this case 340, and the expiration that is at least 90 days to expiration, in this case June 21st, 2019. And I select Buy Custom Genie Trade. And you would identify, and let's select Analyze Trade. We go back to the Trade tab, and this time I'm going to select 3 puts by clicking here on the Ask. 1, select 3, then add 2 puts, same strike price, just same expiration of March as in our Genie, and strike price of 340, and just press the Control key and add a 1 short put or 2. And then go back to the back month and select one single long call. And this is your put Seagull. At this time, we can save that template as an order template and enter put Seagull for future use. Next, we create a call Seagull simply by inverting the existing calls to puts and puts to calls. It is synthetically the same trade, but we're going to call it the call Seagull. And we can simply now save a template as call Seagull. Save it. And now we're going to take it to the Analyze tab. And do the same with the put Seagull, or simply create a copy and then change calls to puts and puts to calls, and to create back the put Seagull the way we had created it before. Note how the price is very close but actually different. So you may choose the one that is cheaper because synthetically they are the same. Look at the risk graph and analyze delta, theta, and vega. Those are important features, and the cost obviously would be different. But let's assume that we have the Seagull here. Let's select first the Genie, and we can see that it's a delta of 1884, theta of minus 2.92, and vega of 255. Let's select now the call Seagull. And see how it's changed. Turns out it is very, very close. Okay, 255, 292. See how the thetas are actually less here and the deltas are more. And then compare that to the put Seagull. Very, very close as well. So you may select based on price, and here in this case the put Seagull is the cheapest. Having the 3 different synthetic positions, you can compare which one is best for you in your particular case. Here we have our Genie, which is, as I said, 2 long calls, 2 long puts, 1 short call, and 1 short put. The Genie, however, is the same as 1 long call, 3 long puts, and 2 short puts, except that this time we call it the put Seagull. A synthetic equivalent is to the Genie is 1 long put, 3 long calls, and 1 short call, and we're going to call that the call Seagull. Keep in mind that these are synthetically the same trade. And that is all for today. Thank you very much. Goodbye.